702.
You're listening to the best of The Money Show.
The Money Show.
Welcome to the best bits of The Money Show, a digest of some of the most important thoughts, insights and interviews that we had from the show this week. If you'd like to hear more, please go to our website or your podcast app and search for The Money Show. Always a good idea to pass it on if you think some of it's particularly relevant or interesting, or might even make someone you know who's about to make a decision think again. Maybe just WhatsApp the podcast to them and share it to them in that particular way. Tonight we bring you a mixture of stories from the world of money from the week that has been. Your consumer ninja, Wendy Knowler, looking at the true cost of after-sales service. There's been so much talk about newer, cheaper models of car coming in. We all know what the service can be like for some of the older established models. Wendy Knowler trying to see what's happening with the newer cars, and particularly a flagship SUV made by Chery, and some of the problems that one of the people in her inbox had with that. Wendy Knowler, quite an interesting story to tell you.
Yeah, so it's the Chery Tiggo 9 plug-in hybrid. It was introduced to South Africa last August, and Ricardo bought a demo model from a dealership in Alberton in January. And actually, he's bought two Cherys from the same dealership this year. But that flagship, very pricey, almost R1 million car of his, the Tiggo 9, developed a noticeable vibration at high speeds particularly, and the dealership investigated found that the acoustic foam inside one of the tires had come loose. So that's a layer of foam glued to the inside of premium tires to reduce road noise in the cabin, to give you that insulated feeling, right? So Chery's prescribed repair protocol is to reattach the foam rather than replace the tire. Fair enough. Dealership did that, didn't work. Within 2 days of collecting the car, the vibration was back and getting worse.
Sure. Okay, so if it were me, I would have gone back and said, look, I would like a new tire this time, please.
Yeah, which is what he did. And he was told what all dealerships say about tires, and that is that they're not covered by the warranty, being a wear and tear item. And that's generally true, but this was not wear and tear, as I pointed out to Chery South Africa, and it wasn't accident damage. This car has just 12,000 kilometers on it. Foam detaching inside a tire on a virtually new car can only be called a defect. And of course, there's safety elements as well. The car's been driven mainly by Ricardo's wife with his two young children, and he wasn't prepared to accept a vibrating car, as you know, that's, you're going to have to deal with it. So he copied me on an email that he sent to Chery 2 weeks ago about the issue, and I then responded by sending Chery SA a media query pointing out that in terms of Section 56 of the Consumer Protection Act, if an attempted repair fails within the first 6 months, or actually at any time, let me refresh that. If a repair to a defect that happens in the first 6 months, as this did, fails, then the manufacturer cannot attempt a second repair. The consumer is entitled to a replacement. And I made the point that you can't, we all know this, you can't just replace one tire. You've got to replace at least two, right? Both front or back, to preserve the car's steering, braking, and traction.
So what happened
that was
after?
my email.
So what happened after that? What did Chery say?
Okay.
No one wants to get an email from Wendy Knowler.
Well, I first heard from Ricardo himself, who shared an email from one of Chery's customer care managers to say that they are replacing the tires, not 2, but 4. And that's going to be done by the end of the week. And I confirmed that with Chery South Africa's media liaison person. So I would say that's the right outcome. And it's the second time this year that Chery has surprised me on the after-sales front. In January, a medical rep in Durban wrote to me about her 3-week-old Chery Tiggo 4. She loved everything about the car except for one thing, which made her feel unsafe. Every time she cut the engine on the car, all 4 doors would pop open, and she felt vulnerable if she was sitting, stopped and was on her phone or something like that. And I didn't hold out much hope. She didn't want the car anymore. It was very new at the time, fairly new at the time. The company acknowledged the security risk in the South African context, authorized a full refund, and revealed that its research and development team in China was working on a revised locking logic specifically for our market. So that was pretty encouraging, I would say.
Yeah, very much so. I mean, I realize people are very careful about that sort of thing. And for a long time, actually, cars sold here have sort of had an auto-locking feature when you start moving and all sorts of things. Some of the other brands, the cheaper brands, there's, I think, a perception that maybe they don't sort of do much after-sales stuff. What are you finding when you get in touch with people, when things go wrong? What does your inbox tell us?
So I'm finding, particularly with the Chinese brands, and I think, they understand it's all well selling loads of cars, but if they have a reputation for poor after-sales service, it's not going to serve them in the long run. So I'm finding, admittedly, people come to me when they haven't been able to get the response that they want themselves. And I'm finding that they just they exceed my expectations. Just before coming on air, actually, I'd taken up a case of two, what were they? Let me not say the wrong brand. Goodness me, just 1 second. Jatua. Two T1s, SUVs bought in different parts of the country, 2 different cases, both bought in January, both experiencing electronic issues. And because they weren't major mechanical safety issues, they were being told, repeated, let's try and fix it, going on for months. I took up the case and I said, is this the kind of after-sales service that you stand by? And I've just heard now that they're replacing both the cars. And this is what I keep getting. It happened with a BYD vehicle that I took up recently. A major part failed at just 2,500 kilometers. Car was 6 weeks old. When the part finally came from China, well, I shouldn't say finally, 2 weeks later, neither the dealership nor the OEM, the car maker, could figure out how to configure it into the car because they'd never had this problem before. And I said, well, it's 4 weeks off road. Will you consider replacing the car after 6 weeks? And they came back and said, we'll replace it right now.
Sure.
So, so that's kind of what I'm seeing. And I then asked the motor industry ombudsman, Johan van Vreden. I said, what are you seeing with these cars? How are they dealing with after-sales issues? And he said, initially, the response to consumer disputes was what he called poor, to say the least. He said, but after our office made a concerted effort to explain the CPA and its consequences to them, they have certainly come around and are currently performing just as well, and in certain instances, more enthusiastically than our traditional automotive industry. And I think we can take from that they really, really are putting concerted effort into making sure that they don't have a reputation for bad after sales.
Very quickly, Wendy, I mean, apart from getting your email address, what's your advice to someone who's looking at some of these SUVs, these Chinese SUVs at the moment?
Okay, so I would say if a defect occurs in the first 6 months, that you must know that the CPA is going to entitle you to insist on a repair or replacement or a refund, your choice. Put your complaint in writing, escalate past the dealership to the manufacturer if you have to. If you don't get anywhere and the car is financed, ask your bank to cancel the deal. There's a Supreme Court of Appeal ruling that says you can do that. If that fails, go to the Motor Industry Ombud. That's free. Or the National Financial Ombud if your bank won't do anything. And of course, there are journalists such as myself who will take up your case, but know that, whatever badge you buy, there's a chance that things will go wrong. Ask about their parts holding and ask about their policy for VOR, which is vehicle off-road. Ask them, how many weeks before my car's off-road will you give me a courtesy car? And hopefully they'll say 1.
Sure. Your consumer ninja, Wendy Knowler, there, looking at trying to get a Chery flagship SUV fixed, but also looking at what's happening with Chinese vehicle brands in South Africa and after-sales service.
The best of the Money Show
on 702.
702.
Your shapeshifter this week, the ever-fascinating Dr. Mark Nasila, Chief Data Analytics Officer for First Rand Risk, but really an expert on AI, started with mathematics, loves numbers, particularly because his dad loved numbers too. Dr. Mark Nasila has so many interesting thoughts on what AI is doing in business, in banking, in society, and how it's going to affect you.
My first influence was my dad. And he was a statistics lecturer.
Oh, really?
And he taught me statistics in first year, and naturally it was very easy to connect. But I've always had a passion for logic, how the world is connected, and I felt numbers were better placed to represent that. And hence my passion. When I look at my transcript from high school, I think mathematics stood out very clearly that it was an area that I felt much in love with.
You must have been quite difficult to teach, because your father would have known more than the teacher, and therefore you probably knew more than the teacher.
More passionate, but also more connected to the subject. And it was less effort being committed to the journey of, applying knowledge, studying calculus at university, and going all the way to doing mathematical statistics as a PhD.
I'm going to ask you about your thesis in a moment, but I'm always interested in people who are good at maths. And I've met some people who I can just see are naturally good at maths. Some of them I've met socially, and I can see they see the world differently to the way I see the world. Now, some people see the world very visually. I don't. I see it through words. But some people do see it through numbers, like yourself. And yet, I think as a country, our big weakness is that we are not producing enough people who are good at maths. And that is about opportunity as well. How important was opportunity for you?
For me, I felt I was very lucky in the way I was taught mathematics. I felt a lot of my colleagues went through a journey where mathematics was positioned as a very complex computational subject. I was a bit lucky, but from high school, university, and all the degrees, it was positioned as a subject that represented the world, how the world works. It represented the logical aspects of how the physical world and how things worked. And it made it interesting, and it drove my curiosity. And when I finished my first degree, I felt there was more for me to study to be able to apply knowledge. Hence, I had to pursue, further studies. But it's more about connecting it to the world and making it relatable, which I feel everyone should study mathematics.
So if you say to someone, maths is all of these numbers and formulae and X's and Y's and goodness knows what they come up with, that means one thing. But if you say to someone, look up at the sky at night, the stars are where they are relative to each other because of mathematics, that's a different sell.
Exactly. And that's what we call today explainability of how things happen. In primary school and high school, people are taught how to pass mathematics.
Yeah.
They're not taught to understand the things they're taught in mathematics. I do think it's, to me, without prejudice, it's one of the easiest subjects because it connects how things work, the world in which we're in it today. It connects inputs to consequences as a function of how we relate to the world, the physical world. And you look at it closely, it's a subject that is very easy to understand if it's taught well. But you see, the young stage of learning mathematics is very, very important, especially at an early childhood level, because that's where the logic is embedded in someone's development of the mind.
So, I mean, I think it was true 100 years ago that if a country was producing lots of young people who are really good at maths, that country was going to do well. And if you weren't, you aren't. And I look now at the big gap between us and so many places like the United States and China and bits of Europe with AI. And I kind of almost shudder about how big that gap is. I mean, is that something you think we could ever fix? I mean, we would need to start even before grade 1, really.
We can fix that. And I think this revolution we're seeing today is leading to the reimagining of the future of education. And not just mathematics, but we're talking about skills like critical thinking, the ability to adapt, to learn and unlearn, which together work with mathematics. But it's an opportunity today to do that much easier, other than to wait for another wave when the whole world has moved on further. it's not going to take that much effort because, what they say, mathematics is the mother of all sciences. And I've seen in some departments in universities where mathematics falls under the Department of Psychology because it's an enabler of everything across all domains.
If I had to go to almost anyone and say, the Chief Data and Analytics Officer at First National Bank Risk and a person who's an expert on AI, where did they study and which province are they from? Almost certainly people would say to me, UCT, Wits, Western Cape or Gauteng. But in fact, you're a Kenya, but the Eastern Cape.
Yes, Walter Sisulu University. And I've had a very adventurous journey in my studies. I did mathematical statistics and computer science at Walter Sisulu. Then moved to Nelson Mandela, did an honors, then master's. Then I felt I needed to apply knowledge. I had the theory of mathematical statistics and computational sciences, and that's why I joined the bank and decided to pursue a PhD. And it may be the most exciting study because my PhD was about applying mathematical knowledge in solving real-life problems. And at that time, big data was something that was booming. The likes of Google, Facebook was starting, to go big. And I could tell that machine learning was going to shape the future.
So I looked for the title of your PhD and I couldn't find it. And I'm sure if I spent more time or known which AI model to use and spoken to you beforehand. But I do know that it focused on rare event modeling, fraud, money laundering, and default risk.
Yes.
So when you talk about trying to apply it, what were you trying to do? Were you trying to say when someone like Grootes is going to go bust?
So these were machine learning models for identifying these events accurately as a way of creating operational efficiency. Statistically, you're trying to flag a rare event, an event that happens very few times. In the financial services sector, fraud is a very small proportion of all transactions. And therefore, traditional statistical techniques struggle to learn to differentiate between what is suspicious versus what is not. So my PhD was about improving on the existing theory to adjust these techniques so that we can be able to use data to behaviorally and accurately detect these incidents.
I would imagine in a world in which it seems there's more and more risk for various reasons, your thesis becomes more and more important.
So the structure of this problem actually represents how life works, whether you're in the building and construction industry and you're trying to understand how many days of the year will rain so that you can plan properly. The financial sector, rare diseases, that's biology. If you look at the aviation industry, things you want to know happen rarely because most of the world happen in a very deterministic way. And the statistical structure of the problem is the same. And up to today, machine learning and AI experts are still trying to improve on this methodology to cater for some of these events because they don't happen often, but when they happen, they're very disastrous and expensive.
The field that you work in, how has it changed in the time you've been working in it? Because now everyone in public just talks about AI.
Yes.
But when you started, that's not what they were talking about. As you say, machine learning was the sort of thing. Now it's very different. I mean, you must have seen it change quite fundamentally. Did one lead to the other? It would make sense to me that big data, machine learning would, that AI would rely on those two things.
It's been a bit of a build on each other and probably a mass improvement. And it's been driven by three major factors. When I joined the bank in 2010, I was a data scientist. We built machine learning algorithms, but more focused on things like marketing, credit scoring, trying to offer the right customer the right product. But the computational power that has come today, the amount of data that's been collected, and also just the improvement of the science and its ability to solve problems and represent life has meant that we can actually do more, and it's been a build on that. So some of the techniques we use today existed for maybe 20, 30 years. The AI we talk today has actually been there for a long time. Some of the deep learning techniques we're talking about. It's just that the fact that we have got so much data and the digital connectivity we have is generating so much interaction. Our behavioral data we're generating is allowing us to model more and more things, predict the next word and the next word, which is what we have in platforms like Gemini and ChatGPT.
So, I mean, I think a lot of us. So I mean, it was a long time ago that a computer first beat a human being in chess, consistently. Okay. And yet it was really only kind of 2022, 2023 that everybody started looking at ChatGPT and consciously, I'm sure there's a word we'll come back to, but consciously using AI kind of on a regular basis, on an individual level. I'm sure that other people were using it before that. What was the big shift? Was it couldn't just have been ChatGPT? Was it something else? Was it just we reached a kind of aha moment, a consciousness moment, when all of these things, deep learning, big data, and computing power, and the cheapness of it, and presumably computer access, all of these things suddenly arrived at this moment?
So I think the science existed.
Yeah.
When you talk about the Go game or the computer beating, Kasparov, it's a similar science, reinforcement learning. The transformer model that is used to engineer ChatGPT existed before. But I think the excitement around the Go game or the chess game is less compared to the excitement about the fact that you've got an AI system that can predict and generate human-like language. That actually, shifted the level of excitement. But also, let's not forget, it came up immediately just after COVID, where the whole world was down, recovering from these lockdowns, and therefore we needed something to drive our excitement up. And when ChatGPT was launched, it gave a lot of business leaders and citizenry hope of how the future could turn out.
Could it also just be that ChatGPT is more like us because humans like words and images, which ChatGPT does and did, whereas before it was really a very specific, almost mathematical thing. Beating chess, Go, which is much more complicated than chess as far as I understand it. That's all quite mathematical. So that would have got Mark Nasila very excited. But Stephen only got excited when it really did words.
ChatGPT is equally mathematical. It's not close to being to us, and I'll tell you why. These are just probabilistic models that predict the next word and the next word based on how these words appeared on the data they were trained on. There's been talk of artificial general intelligence reaching human level. But being human is not about predicting words and generating language. Look at you and I are speaking now. I'm holding a mouse next to a microphone. Our physical world has got more than generating language. It's made of more interactions. So they are probabilistic, but I must say this science is on another level because it's promising so much reimagining of the future.
So long as you take the red pill, right?
Exactly.
Dr. Mark Nasila there, the Chief Data Analytics Officer at First Rand Risk, looking at the road from maths to AI and what that means for our future.
702. You're listening to The Money Show's best bits.
Personal finance this week. Why some of the market's best days often arrive just after the scariest headline. Warren Ingram, the financial advisor, co-founder at Galileo Capital, explaining why if you try and time the market during a period of uncertainty, it won't pay off. And effectively, you have to stay in the market for a long time, which means you have to live with some of the really bad days.
Absolutely, and I think it's such a human emotion, and often, when our lives are threatened, it's a very good strategy, to avoid danger and get yourself, to a place of safety when you can, and that's a great way to survive. But in the investment world, that urge, and it's pretty primal, it's part of our lizard brain, is often the kind of drive that forces us to make decisions that actually act against our best interests, and something that I think we just need to pay attention to, and pretty apt time to talk about it, because the world's in a scary place again, and both from geopolitics, markets, and the like. And I suspect that lots of people are feeling a bit unsettled, and so it's a good time to remind them that maybe it's time to embrace that sort of sense of fear and fight the lizard brain.
Okay, if you're wondering why we need to fight the lizard brain, why we need to stay invested, 011 883 0702 021 446 0567, and voice notes, of course, please, on 072 702 1702. Okay, so a part of this is about trying to time the market. You can see that bad things are happening. You want to keep your money safe somewhere, and then when it starts to rise, you want to buy back. Why is that so difficult?
You're forced to make quite a few decisions when you think you might just be making one. So the first decision, which is maybe the most obvious, is you decide to buy an investment, and you make your call, and it's a good decision, it's rational, everything's going well, and then life is trundling along, your investment's growing, and then all of a sudden the world gets a bit scary, and you look around and you go, hang on, this is not so fun. Maybe what I need to do is sell my investment now, and although I'm happy with it normally, I just shouldn't buy it or own it right now, and I'll sell it, and I'll wait for the inevitable to happen, the bad news to happen. Things will fall. The investment I want, that I currently own, it will then drop, and I'll buy it again, and then it will rise again. So the theory around that is pretty intuitive. It's something we all understand. The reality is much different, because what happens is you've got to make 3 almost perfect decisions just to try and get one thing right. The first is you've got to buy a quality investment at a low price, and you've got to let that grow so that you make money. But now you decide, well, hang on, this quality investment might fall. So you've got to sell it before the crash. So that's the first decision you have to get absolutely right. And then you've got to hope that when it falls, you're fast enough to buy it before it recovers again. And so now you've got to get 2 decisions perfect in a row. And history shows that it's a very nice concept on paper, works perfectly in every textbook ever written, but in the real world with real money, almost nobody gets it right. And if they get it right once, let's say some famous trader gets it right in 2008, the next big event, when you think they know how to do this, you realize they don't, they get it wrong. So what happens is we put the experts on a pedestal and failing to understand that they were simply lucky the first time around.
Okay. And then the other thing is that you don't know when the biggest up day will be and the biggest down day will be. But if you just look at the JSE over the course of a week and look at the biggest rises and falls over the course of a week, those days are often very close to each other. They actually happen in the same period sometimes.
Yeah, so it's astonishing research. Often you'd think, well, the really good days in the market, and to give it context, a really good day would be when the market jumps by more than 5%. That's an astounding day, and sometimes it'll go up by 9 or 10%. And you would think that those are the days that happen when the world is incredibly positive, when people are just so happy and economies are booming, interest rates and inflation are low, and we're all just monumentally positive, and then we get an astoundingly good day. That's not true. What generally happens is the best days in the market, when you get a 9% or a 10% jump, happen after the market's been absolutely smacked, and people are desperately fearful. The headlines are blood on the streets or something, equally dramatic. And then all of a sudden, a bunch of investors almost randomly look around and say, well, hang on, there's some really quality things out there that are trading at almost no price. They're incredibly cheap. I'm going to buy. and then you get one of the best days in the market. And the problem is you need to be in the market on those days, and the only way you do that is to embrace, those lousy headlines.
Okay. I mean, obviously you want to miss the bad days. What happens if you miss a few days? I mean, I presume there must be consequences to that. You can miss just a handful of days. What would happen?
So let's talk about missing the best days. So now we've established that those best days happen in really bad times when everybody's really scared. Now, over a 20-year period, and 20 years, is roughly 5,000 days. So it's quite a few days. If you miss the 10 best days out of that 20-year period, your returns generally are about half of what they would be if you just bought the investment. So let's just say we talk about the index. You buy the index, you do nothing, and you invest your money. Let's say it's 10,000 rand. You put 10,000 rand in the index, and you let it ride for 20 years. So there's lots of crashes and booms and all sorts of scary headlines all along the way, but you do nothing. Your 10,000 rand after 20 years will give you round about 65,000 rand. So nice return. You did no work. You didn't have to trade or make any decisions, but you missed the 10 best days in that 20-year period. Your return's going to be about 32,000 rand. So not even half. And just think about that. How is it possible to be so accurate that you're going to get 10 out of 5,000 days? So the answer is you can't. And now you've halved your return. So you have to embrace I guess that's the message I'm really trying to land, is about the best days are amazing days to be invested. The problem is they happen when things are really not going well everywhere, and everybody's shouting at you, from the media to your friends to your stockbroker, everybody. Your mother-in-law is even telling you that things are going bad. Your hairdresser's telling you it's time to get out. And then the best days happen, and you've got to be in them to get that return of the 65,000 and not the 32,000.
So, I mean, just in a calculation of 5,000 days and 10 days, I mean, you're just not going to get that right. No one in the world's going to get that right. That's why trading is so interesting, I suppose, is because it's impossible to get that right.
Yeah, and I think a lot of people would now say, well, hang on, I'll just create an AI bot and it will do it for me. The difficulty you've got is that eventually, unless all markets are only run by trading bots, if there are humans involved, you have to account for the irrationality of the crowds, the madness of the crowds. And that's the thing you can't calculate. So that's the problem with investing, is it is going to be irrational in the short term. And how on earth are you going to get 10 days out of 5,000 right? How are you going to predict that? And I just don't think it's possible.
Okay. I mean, I'm fascinated by the fact that the bad days and the good days happen so close together. But I suppose if you think of some of the more frightening things we've seen, there's probably an important reason why that happens.
Yeah, and so one of the ways to kind of turn this on this head, which is what some people would do, is say, okay, well, hang on, why don't I just develop a strategy rather than, instead of trying to aim for the best days? You've just said that that's really not possible. And maybe someone buys that point. Why don't I then just kind of avoid the worst days? Now your problem is that the worst days are almost side by side with the best days. So when you're in, like, I think a great example is the COVID crash. It's something that was entirely a shock to the system. It wasn't driven by inflation. It wasn't driven by overvaluations. It was a pandemic that just flooded the world at really short notice. And markets, fell incredibly quickly. And so you can't just avoid the bad days, because they are going to be a surprise. I know we had this conversation early in the year about valuations, and you could say, well, hang on, sometimes, we know bad days are coming because valuations in markets are high, and that's a more predictable kind of a thing. Okay, but you can't forecast a pandemic. You can't forecast a big war or a terrorist event or something that causes huge market events. And so you can't, unfortunately, avoid all the worst days either. And then remember that, when the worst days happen, they're right next door. Almost, if they were kind of people, neighbors, they would probably rock up at the same party. They are just hand in glove together.
Okay, so if you look at what happened during COVID, everything fell and everything jumped all at the same time, and that's just the way it goes. So then what do you need to do yourself? So markets will be falling. You will start to worry about that. Everyone will be saying, your spouse who you share your money with will be saying, get the money out. What are we going to do? How do you manage that?
I think firstly, understand it before you allocate money to investment markets. So you've got to know that volatility, which is just a fancy word, or a fancy way of kind of saying the roller coaster ride. It's a condition of markets. You can't get opportunities for investors to buy things at a good price, especially quality investments, if there isn't volatility. If everything's stable and predictable, then you're not going to be able to make, good capital growth over long periods of time. So embrace the volatility before you invest the money. If you're investing as a couple, as a team, look each other in the eye and say, we do this and we don't sell when the news headlines are scary. We're going to remember this thing of 10 days out of 5,000, and so prepare yourself for that and say, okay, the deal here is my job as an investor is choose quality investments and then stay the course, stay invested, and most especially if the markets do have a big hiding, and you're a monthly contributor, you do a debit order into your investments, or you invest every 6 months, or whatever the deal is, whatever your pattern is for investing, keep going. What you need to make peace with is that what you're probably doing is buying a very high quality investment, and it's now a third of the price of what it was a little while ago. So don't now get suckered into the headline fear and say, well, hang on, maybe I'll just stall the new investments and I'll wait till things get better. You actually, the headlines are giving you the opportunity to buy fantastic investments at the moment when everyone else is selling, which means you're getting the deal. And that's why, I always think, when we talk about things like tax-free savings accounts, unit trusts and retirement funds, the discussion is always these are long-term investments. So understand that long-term investments are designed for decades of growth. That's how you compound. You've got to allow the money to work for you, and that means you look at volatility, and if you're a saver and an investor, you should kind of be smiling a little bit to say, okay, there's volatility, there's a lot of noise and a lot of fear on the streets. What I'm going to do is I'm going to try and become a buyer of everyone else's panic selling, and I benefit when I look back in 5, 10, and 20 years' time. But what I shouldn't do is fall victim to all of the fear-mongering that causes me to sell the quality thing at the wrong time.
And I suppose if you stay in over a long period of time, you're the ones who create wealth because you've kept the money in one place.
Yeah, and I think it's that, go back to do you want the 32,000 or the 65,000 over exactly the same amount of time with exactly the same amount of money invested? And so, we kind of know it as an academic concept that, that people, when you put them in a large group, and the largest group I can find is the stock market. People tend to behave badly. They don't behave rationally, etc. So rather than fall foul of that madness of crowds, say to yourself, I'm the exception. The superpower I've got is I can't be cleverer than everybody else. I can't second guess all the big financial institutions and fund managers and buy better investments than they can. But what I can do is buy quality investments, potentially the same ones that they've bought. But I can stay invested when they fall subject to the panic, and I can carry on because I've got a game plan, and I can do that without having to worry about everybody else. And that's the secret to building real wealth, is not running for the exit when everyone else does. In fact, you should be running into the madness to keep buying.
Warren Ingram there, the financial advisor and co-founder at Galileo Capital, looking at why reacting to scary headlines or trying to time the market really doesn't work for you over the longer term.
702. The best of the Money Show from this week.
In Investment School this week, we looked at algorithms, AI, and the future of markets. Feroz Basa is the head of global emerging markets at Sanlam Investments. Viv Govender is portfolio manager at Rand Swiss. We started by looking at what's changed over the last 20 years. Think hedge funds, passive investing, algorithmic trading, leading into AI. And then, is there still a role for the human being, the active fund manager, in all of this?
I think 20, 25 years ago, the markets were so much easier. It was much more difficult to find really good ideas and really go through annual reports. In the old days, we had a library where if you're looking for if you're doing research on a specific company, you'd go to the library and go through 10 years of hard copy annual reports. And that's how you did research, right? Fast forward to today, and everything's changed dramatically. There's been so many things that have changed the market. It's just unreal. And I think the one big thing for me is that, this flood of information that's available to you, and to everybody else with the onset of so many traders in the market, it makes it so much more difficult today.
So, I want to stay on that information issue, Viv, because that must be, there are plenty of big changes, and we'll try and go through as many as we can. But the flood, I used the phrase earlier, tsunami of constant information that comes at you, you would think would lead to better decisions.
Well, understand that the market is a zero-sum game. You're not going to have people beating other people in the market consistently, because there has to be almost a balance between winners and losers. Because you do have a great deal, somebody else had a bad deal effectively. Somebody sold something too cheaply, or you bought it too expensively, and those are the only choices available basically. In terms of better decision making, it's been known for a while that people tend to make bad decisions, and therefore that's why the rise of passive has been so powerful. If you look at historical performances, etc., you find that active managers tend not to perform quite as well on average as the market. There are obviously some people that are exceptional, like a Warren Buffett, etc. But in general, you do find that active managers, people that make more decisions, do less well than people that make fewer decisions, if you know what I mean.
I'm going to talk about passive in a moment, but Viv, the ability to process data, especially using AI, is getting quicker and quicker and more impressive. And does that mean that if we say over the last 20 years, the amount of information available to a trader has, just for argument's sake, increased 1,000-fold, isn't it going to increase another 1,000 or maybe another 1,000,000-fold in the next 20 years? So in other words, this problem of decision-making with too much information might actually just get worse.
Well, yes, most certainly. And look, if as information became more and more available, unfortunately, what it also meant that certain players will get a larger and larger, advantage in that sector. I recently saw an interview between the head of a famous trading company and somebody focusing on AI, and they were discussing how they have different time horizons, including time horizons that are measured in almost nanoseconds in terms of that affect billionths of a second. And that's because they're using computing power, they're using other, sophisticated resources, etc., to analyze data quicker than any human mind can possibly look at it. And these are the kind of things that become more and more available. And as we see AI rise, especially with regards to the better models costing more, the large amount of processing costing more, etc., we're likely to see that shift even greater towards these active managers for these active trades. That being said, even they don't have a consistent record always against just being passive and buying the market overall, which tends to be one of the easiest surefire ways to actually invest in the marketplace.
Okay, so let's talk a little bit about passive investing. And Feroz, the thing about passive investing is basically you bet on kind of the whole market, or you bet on an index of companies. How quickly has that changed investing? That seems to have been one of the big shifts in the last 20 years. There's just so much more of that.
Yes, Stephen. There are few things that have changed in the market. Hedge funds, algorithmic traders, but passives have been the big one. Like we've seen, active managers have consistently underperformed in a very irrational market. And what happened is passive investing has taken market share, quite significant market share. And when you look at the skewness of the market, particularly the developed markets, even emerging markets now to that extent, as these shares go up, the passives have to continue buying, the active managers fall behind. You look at something like, for example, Nvidia. Nvidia was trading on maybe 40 times earnings. The active manager would say, well, actually, I'm not sure about the future earnings. I can't pay 40 times that earnings, but it just keeps going up and up. And it's, it does another 200-300%, and the active manager's blown out the water. But passive management has definitely changed the game completely. I think we're at a particular point in time, so it's easy to say, well, let's throw the baby out with the bathwater because active managers haven't performed. But the reality is that if you look at the skewness of the market, and develop and emerging markets now, it's probably the best time to be invested with active managers. Having said that, like you said, you've got AI coming into the fray now as well. So I've seen a number of AI funds being touted around. We use AI extensively in our bottom-up process, and it's actually mind-blowing what you can do compared to even a year ago, not even 10 or 20 years ago. So yeah, there's been many dynamics that have changed in the market. It makes it so much difficult. So for new entrants coming into the market, coming in and saying, well, look, like for example, one of the top-rated managers, Fundsmith. I mean, he's had a stellar long-term track record. He buys good companies, he doesn't overpay, and he just waits. I mean, I just read his recent quarterly, and I mean, in 1 month he lost 12% relative to the index. So that just shows you. I mean, that was touted as the UK's Warren Buffett. So it's a very difficult market, and all these different strategies coming into the market now, coupled with AI, and we speak about nanosecond trading and stuff. People's time horizons are becoming smaller and shorter. So it's really pressurized the whole active market as a whole.
I might put this question to both of you, but let me start with you, Viv. During the last 20 years, certain things have happened in the global economy which might have meant that they were suited to certain strategies, and passive investment might be one of them. Let me just explain a little bit further what I mean. From the end of the Cold War until, let's just say, the pandemic, but a bit before that, you had a kind of global peace dividend. You had an era of globalization, and that meant that markets went up, and that would mean that passive investments would do very well. But if you'd been in a passive or a tracking investment in the United States on the day that the stock market crashed in 1929, you would have had to wait until it's 1954 for that passive investment to reach the same level of value. That's when the Dow Jones got back to the same figure. Is there a risk that when we say, well, passives have done so well over the last 20 years, therefore it's tempting to think they'll do so well over the next 20 years, but we might be entering a very different era?
Well, certainly. Look, I mean, people often have a recency bias, and the recency bias for much of the marketplace and economists and, market analysts, it just seems to be the last 75 years or so, basically since 1950 till now, post-World War II. And people tend to ignore what happened just before, like you said, World War II, with, the crash and the long period of time taken to recover. Also, I mean, if you had to look at the last couple of decades, etc., and passive investment often involves buying a huge portfolio via an ETF that might be 500 or 8,000 shares, depending on which ETF you're looking at. That's on the more popular ETFs are that kind of size. And if you compare that to just basically buying the top 5 largest companies in an index, often you've found, over the last little while, that buying the 5 largest companies outperforms the overall index. That's because we are living in a point where it's a winner-take all kind of economy. For instance, one company became the leader of phones, which is Apple, and everyone else is, and also that one company became the leader of operating systems, which is Microsoft, and everyone is basically, and also that one company became the leader of retail, online retail, which is Amazon. And in the past, you might have had more benefits from having a more diversified portfolio, and more recently, it's been a case where it's these larger companies that tend to not just do better in the past, but do better going forward. Almost to the winner goes the spoils kind of situation, which might depreciate or might negatively affect your performance versus having buying the biggest winners out there versus buying a 500 share portfolio, which is what you get when you buy, for instance, the S&P 500.
Also known as late-stage capitalism, where the bigger companies do so much better. Feroz, we need to talk a little bit about algorithmic trading. So this is a kind of automatic trading. You trade, you set a computer to trade on an algorithm. You set that, you say, if this happens, then you must go and do these things. And they move very quickly, and what that does is it speeds the market up How's that changed trading? Because that's only going to increase, right? And it's going to go, it's going to be AI algorithmic, or it is already.
No, that's a good point. But Stephen, I just want to get quickly back to your previous point because you made a very good comment. You said the 1929 crash, right? And if you had passive at that time, you wouldn't have made your money back for I don't know how many years.
Yeah.
And you spot on with that. At the time, because I was busy doing an article about it, the S&P 500 reached a cyclically adjusted P, if you take out cycles, of 32 times, right? At the time, it was 1.8 standard deviations above the long-term trend, but the earnings was low. Today, the cyclically adjusted price earnings ratio for the S&P 500 is close to 41 times.
Sure.
It's 2.9 standard deviations away, and the earnings are very high. So I think you made a very good point there, is to say, well, actually, if you take this market and you just take developed markets now as an example, where do you start putting money now? So that's the key question. And I think it's a very good point you're making. Just on the point of algorithmic trading, if you go back 20 years and you say, well, company X came out with earnings was down 5%, 5% underperformed relative to market expectations. Shares going to be down 2-3%. It will hover around there. Company will do a results presentation. Future's not too bad. The company will recover. What algorithmic trading has done is that as soon as a company comes out with results and there's even a slightest of miss, I've seen companies underperform earnings expectations by 2% and the share is down 10% of the day. And you sit back and you think, well, no active manager in his right mind would be selling at this point in time. So what happens is the algorithmic trading picks this up. It's an underperformance relative to market expectations, and they start selling. What then happens is, you also have other market participants. So for example, if you look at the tracker fund, they need to rebalance when shares go down significantly. So they come into the market. Then you have the hedge funds who have all these stop losses in place, and they come into the market. Before you look at it, a share that underperformed earnings by 2 to 5% is down 10 to 15% on the day. So that's how I think, and that's my opinion, how the market has changed with algorithmic trading. So you're sitting there as an active manager and you're thinking, well, actually, did I miss something? And you start panicking and your clients start putting pressure on you. And that's when people tend to do stupid things because we're human. It's like share down 10, 15, 20%, then it's down another 10%. And you're sitting in there with all these losses. Let me also just trim and cut my long position. So it's a long story. I'm sorry, but that's what, all these different strategies have created in the market. Whereas previously you had buyers and sellers. Like Viv said previously, it was easy. You've got a buyer and you've got a seller. One is right and one is wrong, right? One is buying, one's selling. You'll only know in 3 to 5 years' time if that was the time horizon. Now that whole dynamic has changed because of this.
You're with Investment School, how trading has changed in the last 20 years, what that means for the future. Feroz, Basa is head of global emerging markets at Sanlam Investments. Viv Govender's portfolio manager at Rand Swiss. They're with us for another few minutes.
The Money Show. Investment School.
7 minutes to 8 the time. We're talking about algorithms, AI, the future of markets, how trading has changed in the last 20 years. Viv Govender is the portfolio manager at Rand Swiss. Feroz Basa is head of global emerging markets at Sanlam Investments. We need to talk about the role of humans in all of this. Viv, do we still have a place? I mean, obviously you work in the market, so you must think that you do. How is the role of a human being changing when so much of this is being done by technology?
I think it's shifting some of the roles in the marketplace. I think if you're a new entry to the market, a junior analyst, for instance, I think things are getting a lot tougher for you. A lot of the stuff that you'd be expected to do for a few years to get your teeth, to kind of like sharpened for the market, get your like your ceilings in place, etc. That's going to disappear because now most senior people can use AI to make up those jobs. But there's still a certain level of overarching benefit that's available by having a human involved in the process. In chess, there was a period of time after the invention of the chess programs where the best program was better than the best human, but a human combined with a program tended to beat even the best programs. And this was called like centaurs, which is like a half man, half horse, half human, half machine. And right now we are in that period where the best analysts out there, the best fund managers actually are benefiting from the AI. It's possible in the future, maybe 5, 10, who knows how many years in the future, when we get to the current situation with chess, in which case no human input is the best, because the best computer is better than any computer with a human input, because the human input is just making it worse. But unfortunately for me and other people that do my job right now, we are in that period where a human combined with a system does better than either a human or a system.
Feroz, are there some things that AI can't do that a human can do that will always make them, or certainly for the moment, make humans important in the investing process?
I'm hoping so, Stephen. If you listen to Elon Musk, he's saying now everybody will be living on the beach and having all the spare time because AI will do everything. So if I just give you a live example, right? So what AI has done for humans is that it's brought down the time frame. So take a typical analyst. A typical analyst would have to build a model, go through all the forecasts, put that into a model, then come up with a presentation, go through the industry analysis and all of these things. And typically it would take, on average, for a very experienced analyst, at least a month to 6 weeks to come up with that work. That analyst can now do that in a matter of a couple of hours in terms of getting all that work done. What it does is it gives the analyst time to focus on the important things, to actually analyze the company, analyze the data that's being provided, analyze the industry. And I think that's where the analyst has the edge over the AI, because actually it's drawing all this information that's coming from everywhere, right? And AI is only as good as the input and the prompts. So, the human being with the best prompts, right, and knows how to use AI effectively will do much better than AI on its own. So I'll give you a classic example. SpaceX, the new Elon Musk, it's now a $1.5 trillion company, right? It's making no profits. All the information is positive on it. Everything that AI is getting in on it is very positive and very sophisticated. But if you add the human touch to it and say, well, actually, is this a 1.5 trillion company? It doesn't make any profits. Yes, there's future optionality with space exploration and all of these kind of things. But what am I willing to pay for that optionality? Maybe it's less than half of that. And I think that's where, in the investment side, where the human plus the machine has the edge over just the machine.
Viv, we've got literally 20 seconds left, but experience and understanding humans that will be making decisions that affect companies surely matters.
It certainly does. Unfortunately, that's only a temporary thing that we have an advantage for. I mean, if AI continues to progress as it has, there's no actual scope of cognitive ability that humans basically say we would never lose to AI. And I think that is the one danger out there. And one thing I think we haven't mentioned as well is one of the things that has changed over the last little while is because of the explosion of information, the richer guys also are able to put more different, bespoke data into these AI machines, which are going to be even more difficult to beat in the long run.
Feroz Basa there, the head of global emerging markets at Sanlam Investments, and Viv Govender, portfolio manager at Rand Swiss. How technology is changing financial markets, how it changes the way that we trade.
702. The best of the Money Show from this week.
You've been listening to the best bits of the Money Show, a digest of some of the best interviews from the show this week. If you'd like to hear more, you can go to our website, your podcast app, and search for The Money Show. Thanks for being with us this week. I really do appreciate it. We'll be back with you on The Money Show, 6 o'clock on Monday. Have a good weekend.